Good afternoon, everyone. We are talking about homestead exemption in Florida today. We're going to take an in-depth look at exactly what homestead exemption is, what does it mean, and how does it work. So Florida has very specific rules in reference to homestead exemption. There's a lot of really great benefits to homestead exemption that are outside of property tax benefit, but the primary benefit that everyone knows about and talks about is the tax benefit to lower your property tax on your home. However, an interesting fact is one of the benefits of homestead exemption that's not often talked about is creditor protection, which means that if you were to get in a situation where somebody sues you and they have a lien against you, they cannot take your home or force you to sell your house or liquidate your home in order to pay a lien off that has to do with a creditor. So there are other creditor protection things in the Homestead Act, which makes Florida a much more favorable state to come to if somebody is having some type of creditor issues. And that is something that a lot of times it's not talked about. But let's get into really the details of what homestead exemption does for properties and how it reduces the taxes that you pay for a home. So basically, a homestead exemption is only for primary residence. You cannot get homestead exemption if it's an investment property or a second home. You can only get it if it's a primary residence. Now, technically speaking, if you do move out of your house and you start renting the house out, you are supposed to remove the homestead exemption, because then you are then not eligible to continue receiving homestead exemption. Homestead exemption basically provides some financial relief for property taxes for a homeowner. It reduces the tax liability and also limits how much the property taxes can go up. The property has to be a primary residence. You must be a legal resident of Florida. And you have to have ownership of the house as of January 1st of the year that you are applying for homestead for. So for example, if somebody closes on January 2nd of 2024, they will not get homestead for 2024. They will get it for 2025. So it's super important that when you're looking at scheduling your closings, especially we've got the month of December on us now. If you can get a file closed in the month of December, it will give the homeowner, assuming they're going to live in it as their primary residence, some financial benefits with their property taxes for 2024. So let's talk a little bit about how much homestead reduces the property taxes and exactly what it is for. So there are two types of homestead exemptions. There's the $25,000 homestead exemption that completely reduces the ad valorem and the non-ad valorem taxes. So what is the difference between the two? There are taxes that go to the school board. There are taxes that go to the fire department. There are taxes that go to the county. There are taxes that may go to the solid waste facility. There's all different places that your property tax money is allocated to. Part of it is called the ad valorem and part of it is called the non-ad valorem taxes. So $25,000 is reducing a $25,000 homestead exemption is reducing the entire property value for tax purposes. And then there's an additional 25 that also reduces the property taxes, but it doesn't reduce the portion that goes to the school board. So it's not a 1-for-1 reduction, but in total, there is a $50,000 tax reduction for homestead protection. And basically what that does is reduce It reduces the market value or the assessed value of the home or what the property taxes are based on. Now, there's additional tax exemptions that lowers the assessed value, and those things are for people who are disabled or veterans or senior citizens or lower income families. There's also, depending on the veteran, if the veteran is 100% disabled, they actually do not have to pay any property taxes at all. A lot of people don't realize that. But if they're only partially disabled, then they'll only get a small veterans deduction for VA disability. So let's explain exactly what is the Save Our Homes cap and what are the benefits of the homestead exemption. So when somebody purchases a house and they file homestead on the property and they have the benefit of the homestead exemption, the property value cannot go up more, or the assessed value of the property cannot go up more than 3% a year. So the benefit of that is that if somebody has lived in a house for a very long time, they will never see the property taxes go up more than 3% of the assessed value. Not that the taxes won't go up more than 3%, but that the assessed value that the county uses for the millage rate will not go up more than 3%. It greatly protects the homeowner from their property taxes not skyrocketing. So for example, if property values go up 10% or 20% or 30%, or whatever the case may be, the taxes cannot participate with that appreciation. So it's the property taxes will not be based on the market depreciation. It's based on the Save Our Homes cap, which is basically limiting how much the property value, the assessed value for the tax county office goes up. Now, if you do not have homestead and the market has gone up 10% or 20%, whatever the case may be, your home could potentially have an assessed value of 10% more or 20% more, whatever the case may be. So it protects you by having homestead that your property taxes will not see large increases. Now, there is a big misconception out there with how property taxes are reported on homes that are resale. So meaning this is a house that somebody is buying that somebody else previously owned. Now, if somebody purchases a home that had homestead on it, like we're going to use an example of purchasing a $400,000 house, and they're purchasing it from a little lady who has lived there for 15 years, and she bought that house for $100,000, and her assessed value is $150,000, let's say. And you, the homeowner, are now purchasing the property for $400,000. You actually only get the tax benefit of the little lady's lower taxes for the first year. So if you're purchasing the property, let's say in June, the property taxes will remain the same until the end of the year when the property taxes are reassessed. So for the months from June through, let's say, November, you will still be using the lower property taxes in your calculations. However, property taxes are paid in arrears. So what does that mean? Come November, the county will most likely reassess the property taxes and say, for the entire year of 2023, we have now raised your property taxes to an assessed value of $350,000, $400,000, or something closer to what you bought it for, because the prior owner had homestead protection, and the county does not do the reassessments until they issue the trim notice in September, which gives a homeowner an opportunity to contest the estimated assessed value. So the counties issue a trim notice. It actually comes out in August, and then there's a certain period of time in the month of September. It's a very short window where you can say, hey, I don't agree with this assessed value that you're giving me, and I want to fight it. I want to give you comparable homes that have sold lower, and therefore my taxes should be lower. And then in November, they will issue the actual property tax with the final assessed value. So in this scenario, if this little old lady had owned the house for a significant period of time and her assessed value was $200,000, and let's say the property taxes were $2,500, and then a homeowner comes in and purchases the house for $400,000, and now in November their property taxes have gone up to, let's say, $5,000 for the year, whatever the case may be. Now their mortgage payment and their taxes and everything, if they're escrowing for taxes and insurance in the property, will all be based on the new taxable value. Now, that would be the only large increase if they have filed for homestead. They should not see any large additional increases after the first year, but the first year there is a pretty big difference. And it's really important that when you're working with clients, we always tell our clients, hey, this is based on the current assessed value, and make sure that you understand your property taxes are going to go up. But a lot of times, because there is so many different moving parts of the home buying process, that kind of goes to the back of their mind because there's so many other things going on until they get the large tax bill, and then they see, oh my God, my property taxes have increased quite a bit. So it's always very important that when you're working with your clients to make sure that you disclose to them that, hey, these current property taxes are based on the fact that this woman has homestead or this person has had homestead. Now, if they haven't had homestead, it's probably a good chance that their property taxes are much more closer to what the real property taxes will be. But this is a very important thing to look at because we don't want anybody to be surprised if their payment goes up a few $100s later on because the property taxes have gone up. But again, if they have filed homestead, which they have until March of the following year, as long as they were the owner on January 1st, then this should be the only large increase in their property taxes. Every county, or I should say, the majority of the counties in the state of Florida, on the property appraiser's website, have something called the property tax estimators. A lot of them actually overestimate the taxes, which is good because it's better to overestimate. But you can actually send your clients, or you could do this yourself for your clients, and go to the property appraiser's website and put in the purchase price. A lot of times there's an option of even entering the folio number so you can get really exact with what the estimated property taxes are, and you can choose the exemptions if your client is a veteran or a widow or disabled or whatever the case may be, to try to see what exemptions can help you to lower the property taxes. So that's basically what the financial benefit of homestead exemption is. Remember, there is a Save Our Homes value. The Save Our Homes value is different than the market value. The Save Our Homes value is what the 3% is capped at. So for example, the market value is really what the county assesses what the true value of the property is. It's generally lower when what the actual resale value is, which is good because you want them to be on the lower end. But the market value versus the Save Our Home value are two different things. So you may, in this situation, have somebody who has a market value of $400,000 and an assessed value of $230,000 because they had a 3% cap per year. So they bought it for $200,000 in that scenario. And the second year, the property taxes were based on an assessed value of $206,000. So that's where the significant difference is. So when you're looking at the property appraiser's website and you're looking at your particular property that you're looking up for the homeowner, that is the difference. Now, the application process for homestead is very simple. Somebody just has to go online to, you just need to go online to submit the application. However, they do have to have utilities and identification changed over into the property's name before they go ahead and file for homestead. So generally, voter's registration card or their driver's license or whatever the case may be, to prove that they are living there, as well as a utility bill or something to prove that it is their primary residence. It is important to note that there is a late filing that's open through September normally. So if somebody misses the deadline, they may have an option to do the late filing, which is from March through September. So let's quickly talk here about portability and what is portability. So portability of your homestead exemption applies when you're wanting to move to a new property. When the homeowner says, hey, I've lived in this house and now we need to get a bigger house because our family has expanded, or whatever the case may be. Maybe they're looking for a smaller house. Whatever the case may be, they can actually port over a amount of what their homestead exemption is that they've earned. And the way that that works is that, remember how I just said that there is something called the market value that the property appraiser has, which is not the assessed value. That's not what the property appraiser bases the taxes on when somebody has homestead exemption, because we just talked about the 3% cap per year. The market value is what the appraiser's office determines the current market to be in the property. Separately, the Save Our Homes value is what the homeowner is taxed on. So we're going to take the same scenario where we have this little old lady who's lived in this house forever, and she bought the house for $200,000, and the property is currently worth $400,000, but her assessed value is, just to keep numbers easy, let's say it's $250,000. Okay, she's lived in the property forever. She's had that 3% cap, and now her assessed value, or the value she's being taxed on, is $250,000. But the market value is $400,000. What the property appraiser does is takes that $150,000 difference and ports that over as an exemption to the new property. So if the new property has an assessed value of $500,000 that she's moving to, it is now reduced to $350,000. Now, the good part of this is that somebody's not losing the benefit of their portability of their current homestead that they've earned all these years. The not so great part of it is that that new house is also going to be reassessed the first year, even if there's a homestead exemption filed, because remember what I said, the very first year, the county reserves the right to reassess the house to the current market value, even if somebody's filing for homestead. Also, on top of that, the market value that the property appraiser has for the current value of that little old lady's home that she's owned. Remember how I said in the beginning, it's usually on the lower end, and we kind of want it to be on the lower end because that's good for them to use the lower value for property taxes. But it also kind of hurts you when you go to the portability, because that $400,000 market value on the home really may be higher. Like in this example, we're using a $400,000 value, but that house may actually be worth $500,000 or $450,000 or maybe even higher. So even though the property appraiser has the market value at maybe a little bit under market value, there's nothing you can really do to gain the difference. So whatever that market value is always important to know, because the difference between that market value and the Save Our Homes value, which is what the property taxes are based on, is the amount for the portability. Now, a little trick some people don't know is that that market value is updated every year in November at the same time when the new tax bill comes out. So if you're selling a house and you're helping a homeowner move to a new house, it would be really great if you could wait until the market value is updated after November 1st, assuming we're in an up market where the value would be increased, because then they can benefit from the increased amount of their portability. So that's really important to know, that if somebody is porting over the difference in how much they have in their property taxes, they have 2 years to do it. They have to do it within the first 2 years. If they do not request it, they will lose it. And this is really a great option for people to be able to use to have some type of benefit for lowering their property taxes on a new property, because this is a big thing for people to consider. Property taxes will significantly go up if they have lived in their current property for a long time and now they're moving to a new property, and they could have a much bigger tax amount that they're paying that they may need to understand upfront. So the important thing is making sure that you are communicating to your client about estimating the property taxes in the future, communicating about portability. We will also have that discussion with the client, and explaining to the client that if they're not going to live in the property, that it is going to be subject to whatever the market does. Now, in a down market, that could be helpful as well, but generally speaking, in Florida, we're usually in some type of up market or stable market, and we don't anticipate any type of down market because of inventory shortages and many other things that are happening within the market that protect homeowners that weren't in place back in 2008. So we certainly are expecting the market to continue to go up. If you have any questions on how homestead exemption can assist you or your client has questions regarding property tax estimators, please feel free to have them reach out to us. We can explain it to them and let them know what to expect, because the last thing we want them to do is have an escrow shortage and not understand exactly what's going to happen. And you don't want your client to come back to you January or November of the following year and say, hey, my property taxes have gone way up. This is something that we always explain, but again, a lot of times it does really get lost in the process just because it is a very involved process and people hear it, but then when they actually see it, then that's a different story. Okay, guys, well, that is everything for today. We don't have any questions oh, actually, let's see if we do have a question. I thought okay, homestead exemption is the only homestead exemption I know details about is Florida, but there are other states that do have some version of homestead exemption. And I believe those are states like Texas and there's a few other states that I know that have homestead exemption. And then there are different types of exemptions in other states. They may call it other things. But as far as the homestead exemption that actually has creditor protection, Florida is the only state that I know of. So I think, let's see if we have any other questions. We have a question here. Can you get homestead exemption if you're a foreign national? You can't, because if you're not legally allowed to live in the United States, then it's not your primary residence. Now, a lot of people confuse foreign nationals with people who are here on a visa. If they're here on a visa and can legally work and live here, then yes, they can get homestead as their primary residence. If they're here on a tourist visa and they're basically just looking to invest in properties in Florida and visit them and they're a true foreign national, then no, you cannot get homestead on a foreign national or a second home. All right, I think those are all the questions. Thank you so much for attending our webinar. Please join us next week where we're talking about reverse mortgages. And as always, please follow us on our YouTube channel. And if there's anything that we can help you with, remember, we have many more options than banks, and you can reach out to our 800 number to speak with one of our loan officers. Have a wonderful day. Thank you so much for attending.